let's go ahead and get started. You're going to spend probably about the next 60 minutes going over two items. First is going to be just the basics of a self-directed IRA. Brian's going to provide you a quick cursory overview of what a self-directed IRA is. He'll talk about the do's and don'ts to keep you out of trouble, and then some of the benefits that come along with having a self-directed IRA. And then I'll follow up with a quick discussion on TaliMar Income Fund 1, our mortgage fund, providing some information as to what what is a mortgage fund, how you can invest in the fund. And then at the end, we'll also provide Q&A. It is very okay to ask questions during the webinar. Obviously, there's a lot of information that we're going to cover, and we want to make sure that we answer all of your questions. So feel free to use the Q&A. For some of you, it's up at the top. For others, it's at the bottom. And go ahead and ask those questions. And as they come up, we'll go ahead and answer them for you. So I'm going to tell you a little about myself before we get started with Brian. I am a graduate of the University of Michigan. I did some coursework in real estate finance and accounting at UCSD when I started to get involved in real estate finance. Started in real estate finance in about 2001. Prior to that, I was actually in the tech industry. For those that are a little older, remember the dot-com boom and bust. I was very involved in that. I had an opportunity to live up in the Bay Area and kind of see it, take it to the top and see it come back down. But during that period of time, I got really interested in real estate finance and real estate in general and investing. And so I moved back down to San Diego and was hired on as a financial analyst for KeyBank's private equity group. There I ran spreadsheets all day long for various real estate investment opportunities that the bank wanted to get involved with. And it was a really good run. I was there from 2001 to about 2007. Unfortunately, we were heavily focused in the residential ground up construction sector. And in 2007, that really dried up. So I spent the next 2 years with the Federal Deposit Insurance Corporation, also known as the FDIC. Many of you know the FDIC as the company that insures your deposits at the bank. I was brought on there to assist in actually closing down failed banks between around 2007 to beginning of 2009. Great experience. I traveled all over the country, and on Friday evenings, I would go into a bank with my team. We would effectively shut the bank down. We would underwrite all their loan portfolio, and then we would effectively sell that loan portfolio off to institutional investors. I got to see the good, the bad, and the super ugly of the inside of banks. But during that period of time, I got involved in lending money to real estate investors. That was known effectively today as trustee investing. That's essentially when I created TaliMar, what is today TaliMar Financial. In early 2021, TaliMar Financial had grown so large that we decided to move more to a mortgage fund structure, and we actually launched TaliMar Income Fund 1, which I'll get into later in the webinar, in early 2001. We've seen significant growth since then, raising money for the mortgage fund. One of the platforms that we've been really effective in raising money has been self-directed IRA investors. So I'm excited today, again, to talk a little about why self-directed IRA investments or starting a self-directed IRA might be a good investment for you. I do have a California broker's license, and I am a certified fund manager through the American Association of Private Lenders. In fact, actually, I'm a certified fund manager 2.0. They did a follow-up class about 2 weeks ago that went really in detail about how to effectively manage a mortgage fund. It was a great course, spent all day with Jurasi Law Firm on gathering more and more information on managing a mortgage fund. Currently live in San Diego with my wife and 3 beautiful children, and I play competitive tennis. In fact, happy to, Brian, I don't know if you know, but I did win the club championship doubles. So spent it was 2 Fridays ago running around San Diego with a big old trophy.
Now that was for tennis, not pickleball, right?
Oh, okay. Those are fighting words. So no, I am not a pickleball player. For those that are out there, I have nothing wrong with pickleball, as long as the court isn't next to my house. All right, so a little about TaliMar Financial. As I mentioned, I established what is today considered TaliMar Financial back in 2008. For those that are familiar with San Diego Creative Investor Association, also known as SDCIA here in San Diego, it's a great networking event. That's actually where I started TaliMar Financial. So I'm super happy and excited to still be involved with SDCIA. Today, we have funded over 850 loans, primarily in Southern California, totaling over $325 million. So we've got some experience under our belt. We currently service a loan portfolio of roughly 90 loans, totaling about 50 million right now. We launched TaliMar Income Fund 1, our investment fund, back in 2021. We've just grown so big, trying to do individual trustees became too cumbersome, and we found a better way for investors to invest in the loans that we originate. And so we launched TaliMar Income Fund 1. We actually have 42 loans now. We just closed 2 additional loans, totaling over 23 million that we have in the fund. The weighted average coupon is actually not 8.2%. It jumped to 8.25%. I think investing in mortgage funds when interest rates rise is probably the only investment right now that when rates rise, your returns actually increase. So we've seen almost a 3/4 of a point increase in investor returns in less than 6 months. So it's been a good ride with the rise in rates. And then TaliMar Financial, which I'm really proud of, received the highest designation of verified gold by VandenBerg. VandenBerg is our fund manager, and they did a full audit of TaliMar Financial, including our history, did a full audit of myself, and they issued, after that audit, they offered or issued a verified gold status. So excited to have that. So with that information, I am going to hand it over to Brian Davis. But I do want to just say again that Brian Davis has been a value add vendor for TaliMar Financial. By far, he manages the most accounts or self-directed IRA accounts for us. It is such a pleasure working with him. He expedites all the investments that we send over to him. And I want to say that you probably offer one of the best white glove services for our self-directed IRA investors. So I just want to say thank you. And I really appreciate you coming on today and teaching everyone about what a self-directed IRA investment or IRA is.
Well, I'll give you that thank you right back, Brock. And I met Brock in 2009 at SDCIA and NSDREI, the real estate clubs here in San Diego County. And we started doing events pretty much right away after we started talking. And Brock was fairly new with his with TaliMar, what TaliMar Financial is now, back from 2008, and I jumped in 2009. I'll give you a little bit of background about myself. So I'm originally from a small town in Northern California called Yuba City. My family farms rice. And so I was part of that business growing up, driving tractors and harvesters and those types of things, et cetera, before I decided to go on to college. And I went to UC Santa Barbara, where I graduated in 2001. In 2002, I moved down to San Diego. So I'm a proud San Diegan for over 20 years now. And I got into the mortgage business back in 2002, mostly doing subprime loans for Wells Fargo Home Mortgage, until that market crash of late 2007, where after that, I kind of dabbled in life and health insurance for a couple of years before, in 2009, getting involved with self-directed IRAs and solo 401ks. And in 2012, I started working with AccuPlan and their custodian, American Estate and Trust. And I've been with that custodian ever since then. You'll see me market myself with some of my individual marketing for Independent IRA, and you can look me up at independentira.com or AccuPlanCalifornia.com. And just as Brock did with his little disclaimer, all this information is for educational purposes only. I'm not a CPA or financial planner. So please, this is for educational purposes only. Let's talk to your advisors before getting into any type of investment. So AccuPlan and our custodian, American Estate and Trust, we provide custodial services for self-directed IRAs and solo 401ks administration. So we're here to kind of fill the gap that a lot of financial advisors leave and allowing people to invest retirement funds and things outside of the stock market. So a lot of people know a little bit about this that Brock was alluding to earlier, and people are learning more and more just, due to the rise of the information age and the years that this has been popular, especially over the last decade. So this is where I come into play and our custodian comes into play, because we know a lot of the rules and red flags to look for when investing with IRA and things outside of the stock market. So just kind of an overview, and some of these numbers have shifted up and shifted back down. So I think this number is actually pretty accurate, that there are over $13 trillion in IRA assets as of about a year ago. And the majority of these are in securities, which you would think of as stocks, bonds, mutual funds, ETFs, annuities, those types of investments. And there's a large market share that is starting to grow. And at this time, it was 5% invested in alternative assets. And I think that number's been growing steadily. So might have to look into those numbers and see where they're at. I know I'm getting a lot more phone calls just this year based on what the stock market is doing. So
yeah, Brian, I don't mean to cut you off here, but
no, please.
I think that when we first started doing these presentation, it was all about Mitt Romney and how much money that he had invested in self-directed IRAs. And since then, we hear about Peter Thiel, Warren Buffett are all taking advantage of self-directed IRAs.
Exactly.
Why is it, do you think, they're doing this? And what is it that brought them into this?
Well, I think, just by looking at this slide I have here, these are some of the assets that self-directed IRAs can invest in. So you're talking, Peter Thiel, you're talking about private companies. He works in the venture capital world, and he's been able to invest in a lot of private companies with those retirement dollars, and do so using the Roth IRA to explode his Roth IRA. And Warren Buffett, you mentioned, we're talking real estate. And traditionally, real estate has been where my investors have come from. They're in the real estate space, or private notes and loans. And then more and more over the years, it's been people investing in private companies. And most of those are private funds like Brock's TaliMar Income Fund 1, but others are different startups outside of the real estate market. We've also had traditionally a lot of precious metals investors, though I don't deal with that investor too much. And in a similar space now, I could add an extra circle here, as in crypto. People can invest in crypto, though it's been rather volatile lately. So since we've actually got it on our platform, people can invest directly on with their IRA accounts on our platform. It's been the downtime. We've had the platform up for maybe a year. So that's something that's also available.
And the idea, this term self-directed, just start at the high level. It's no different than having your traditional IRA. They just term it as self-directed. Why self-directed, and why traditional versus Roth versus rollover and all these other terms that we hear about.
So the terminology self-directed is really more of a marketing term for our space, of allowing people to invest in anything they want that's allowable under IRS guidelines. Now, you'll hear the main brokerage houses, the Schwabs, the Fidelity, say, oh, we got self-directed accounts too, but that really means self-directing in what securities they have on their platform. When our industry utilizes self-directed IRA, we're more saying, hey, we're not financial advisors selecting your investments. You're selecting your investments, but the real focus with being investments outside of the stock market, kind of like this slide here shows trust deeds and mortgage notes, renewable energy notes, private placements, raw land, et cetera, et cetera. This list could go on and on. Just about the IRS didn't list what was allowed in IRA accounts when they came up with the ERISA guidelines in the early 70s, more of what you couldn't invest in. And they really only listed a couple things. One of those is life insurance contracts.
But at the end of the day, Charles Schwab is not going to let you invest in that apartment building.
Correct.
that investor is going to invest in. This self-directed, we'll call it self-directed IRA, allows you the ability to do that.
Yeah, so we're really talking about alternative assets in that aspect more than a Schwab saying, oh, self-directed, we're not going to pick the stocks for you, but here are the stocks. You can choose them yourself.
Okay.
So we're standing out saying, hey, we're not a financial advisor. We're here for you to invest in these other things outside of the stock market, like the previous slide here showed, amongst other things.
So so go back to that slide.
Yeah.
Give me like generally, if you were to take the top, I mean, you kind of mentioned some of it, but what are the top 5 things that you get people asking to invest in?
Trust deed and mortgage notes, private
Top
placements.
one by far. Okay.
I would say those are the top 2. I don't know what those numbers look like right this minute, but most of the time it's trust deed and mortgage notes and then private placements. And then, below that, you're going to get some more exotic investments, people investing in direct real estate. I'm helping people that want to buy investment properties all the time and how to do that through their IRA. And I'll work with other people that are, they might be working with some other investment. So like I see a lot here in San Diego County in the startup space, maybe people helping like early seed rounds or doing some type of convertible note where it's a note and then if the company boosts, they get subscription units. So it's very similar to a private placement investment, but it's not real estate related. And there's some benefits of real estate investments versus non-real estate investments. And I think Brock might go into that a little further during your part of the presentation.
I'll say that, since we've been working together, I look at, the investors in our fund, and a little over 25% of our investor capital in our mortgage fund is self-directed IRA money. And I think one of the things that is good for a mortgage fund for self-directed IRA investors is the ability to reinvest the funds. So one of the things, when we first started and we were just doing individual mortgages or trust deeds, these investors would get distributions every month, but those funds would land in their account and it would never be big enough for them to reinvest, be able to take that money and reinvest. So it would sit there not earning any income.
Exactly.
But the mortgage fund, they're able to reinvest those distributions. So those then compound.
And I do see a lot more mortgage funds doing what you're doing with TaliMar Income Fund 1, with having that option for people, as opposed to what we used to see a lot more and still do. These funds, they have any type of capital event for the investor, they would move the money back to the IRA, and then the IRA holder decides, do I want to invest some more with this or in the same fund, or do I want to do something else? We're seeing more and more funds have the ability to recapitalize immediately without having to send money to and fro their IRAs.
Right.
Yeah. But again, going back to that, after that huge list, the IRS through the ERISA Act really outlined just 2 things that IRAs cannot invest in. One of those is life insurance contract, as I mentioned, and what the IRS deems as a collectible work of art, rug or gem, metals or gems. But there's been some there were some changes in the 80s to allow specific metal coins in there, alcoholic beverages, things of that nature, classic cars, etc. You'll also hear people say, oh, S Corp. So that's an S Corp rule. S Corps don't allow IRAs to be members of them. But what the IRS did outline that is the trickier part of self-directed IRAs are what we call prohibited transactions. And I'll try to use as less jargon as possible, but this is who your IRA can't invest with more than what your IRA can invest in. So a prohibited transaction is when your IRA gets involved with somebody it's not supposed to. And that would be what a disqualified person would be. So that would be yourself, your spouse. So you can't have any deals transacting with yourself or your spouse, or lineal ascendants and descendants in a straight up and down order. So parents, grandparents, kids and their spouses, grandkids. You're not allowed to transact with those people, versus brothers and sisters, aunts and uncles are generally okay, unless they're kind of circumventing some of the rules and just using that as a loophole. The IRS can go in and say, oh, you're just using that little loophole, but you are having that come back directly to you. And they call that the indirect rule. And an extension.
So for example, like if your child has started a company, or your spouse has, or your parent, you cannot invest in that investment. or even lend
Correct.
money. So, I mean, I'm trying to apply it to trust deeds and mortgages. You cannot lend the money out of your IRA.
Right. So any of those disqualified persons, like your kids and spouse, whatnot, they can't have any, like, that can't help their personal business grow, or else the IRS has kind of deemed that as prohibited. They're looking for you to kind of have more third-party investments and allow you to utilize these other asset classes like real estate and private funds to do
So that's
so.
interesting you bring that up, because this is, I talked about being a accredited fund manager, and this is one of the items they really spend time on is, as your fund grows, and you're going to have a lot of investors that are in the real estate industry, and they've got various types of investments going on. So they may be invested in your fund, but they might be buying up apartment buildings, and they might be investing in development projects. So as a fund manager, it's become a little more complicated, because you now need to verify if you need to, number one, have a list of all your self-directed IRA investors, and then do a quick verification that when we do a loan to a borrower, that borrower isn't somehow connected back to one of our investors. And that's kind of adds a little complexity, but that's
Right.
another step in our underwriting process for the fund, is making sure that we're not creating a disqualified transaction.
On accident.
Yeah, by accident. Yeah.
Yeah. Just because you wouldn't maybe fully know, oh, that is your different last name parent or child or something to that effect. That's very common. So that's one of the main things when I get clients, they're about to do a deal. I say, talk to me about it. What's going on? Who are you transacting with? And if I hear a red flag, I'm going to tell them.
Yeah.
And then, maybe consult your attorneys based off this, if it's like a company thing, because investing in a company in which they're on is not as black and white as 50% ownership. And this can be looked up in Internal Revenue Code 4975 for anybody that has more specific questions about this. Let me know, and I can clue them in on even where specifically in that tax code to look. So Brock, I know I've made you do this before, I feel, but you don't want to mess with the IRS in one of those prohibited transactions, because the IRS can come back to you as of January 1st, the year that transaction took place, and disqualify your IRA. And if that happens, 3 or 4 years down the road, they're going to go back and want the back taxes from 21 plus penalties for everything in between. So this is the most kind of the hard part of looking at self-directed IRAs. And we'll play a little game here, which Brock, I know we played this before, put a little refresher for the audience. I'm sure everybody remembers the game Deal or No Deal from a decade or so ago that was on NBC. So let's play this, Brock. I'll let you answer these questions one after the other. So could your IRA lend yourself $10,000, Brock? Deal or no deal?
Well, that's a good question. If it's not lineal up and down, what's the answer to that?
That one's no deal.
No deal.
Self-dealing, no self-dealing. So that's just the main basic one. You can't do this for yourself or your company, things like that. There's some other structures possibly for that, but we don't need to go into that today. It's not to deal with self-directed IRAs. Now, what about your brother? Could your IRA lend your brother $10,000?
It's lineal, right?
Lineal up and down. It's deal or no deal, Brock?
Deal.
Deal, unless your brother's somehow circumventing that $10,000 and then investing with you or something to that effect.
Here's one that gets like, could it be like a brother-in-law second?
Well, yeah, we got that coming up here in the next two slides or next two parts here. If you had a stepson, $10,000, deal or no deal?
I think it should be a deal, because it's not lineal.
And that is how the IRS looked at it as well. They looked at it as not directly ascended there. And I do not know the answer for half brother or half sibling.
That's a good question. We'll have to get back.
Yeah.
Okay.